Hi, my name's Adam. Welcome to the channel. Thanks for joining us today. Today we have a special guest, Jeff Block. Jeff I grew up with. We used to spend many weekends on your farm growing up. Jeff is a certified professional accountant. He is a partner, original partner, founding partner at Clearline CPA in Vancouver, in Greater Vancouver area, and they focus on corporate tax. So if you're in the Lower Mainland and need help with tax planning, reach out to Jeff. We'll put his contact information below. But we brought Jeff on today to talk about what happens to your world, your financial world, when you pass away. So everyone's going to die at some point, and it's good to go through the process of like what happens when you die, what happens to your assets, the taxes, all that kind of stuff.
When I first started, people talked about estate plan and what is that? What's an estate plan? And really what I kind of sum it up very high level generally is what happens when you pass away, or more importantly, what do you want to happen when you pass away? Hopefully most of your viewers are aware is you've got a tax filing that is reporting from January to December. And what you do is it's called your personal tax return. We say it's a T1. And basically it reports all of your income during that period. Well, on your final tax return, you've passed away and now you're done. What happens is, let's say that happened on June 30th is your date. What you have to do is exactly what you do on a normal tax return. You'd be reporting all of your salary, dividends, CPP, OAS, you're gonna have your donations, your medical receipts. It's a standard type of tax return. And then there's an extra piece that happens on that final return. And this is why the final returns are kind of a big tax bill. Is what happens is you are deemed to have disposed of everything that you own basically 1 second before you pass away. So that means you need to take an inventory of all of your assets, figure out what you've paid for it. So you gotta figure out, your cost base, your ACB, figure out your fair market value, and then the capital gain that happens is also then reported on this tax filing. And that's where it can be a pretty big tax bill. Because if you would imagine, let's just use the very simple one of an RRSP. Let's say you've got an RRSP of $1 million. Well, your ACB on an RRSP is going to be the same as your fair market value. And there's no capital gain in an RRSP. Instead, it's going to be, I know you've talked about on your channel quite often, is that it is all going to be considered income when it comes into your personal tax return.
Correct. And I just want to jump into this. So Jeff's talking about if you die with an RSP of $1 million, that $1 million is included in income in year of death. Now, this is obviously if you don't have a spouse that you can roll the RSP or the RIF over to. And this is why we kind of preach and talk about the RSP meltdown. Like the RSP meltdown, the concept behind the RSP meltdown is to draw out your RSP or your registered accounts as quickly and tax efficiently as possible. And the main purpose behind this is so that this doesn't happen to you. Dying with $1 million RSP, that is terrible tax planning. So Jeff, let's go through kind of a scenario where, let's say husband and wife, maybe the husband's already passed away, everything rolled to the wife. So it's kind of final spouse in the relationship. What happens to her assets when she passes away?
As an accountant, one of the many things that we're going to ask for when we do up your final return is your copy of your will, because your will is going to tell us kind of what happens to the assets. The general comment that I get often is, Jeff, if I had only known how much work is involved being an executor. And so one of the things that I do advise people, and I know you've mentioned it before, is while you're still alive, if you can organize all of your information, because that cottage that maybe you bought in 1963 that you still own will need to be reported on that final tax return. And I need to know the cost base. Maybe you put in a dock, maybe some renos to the house. All of those become part of your cost base. Yeah. And is to your benefit, it reduces the capital gain. Because again, as an executor, you're actually technically personally liable for the tax bill of the estate. So now there's ways, again, that you can clear. It's called a clearance certificate at the end of it to make sure that you kind of remove that liability. But while you're administering the estate, you're actually the one who would be personally liable should something come up with CRA. So what we have, let's just start with kind of maybe a standard high level. You've got a house. You bought it a number of years ago. Let's say it's worth $500,000. When you bought it, it is, of course, Vancouver. So now it's worth a nice $2.5 million. You got a capital gain of $2 million just on your house alone. Okay, let's say you've got your RSP, which we just talked about. You've got a $1 million fair market value, so you're going to have an income inclusion, again, of $1 million on your final return. Let's say you've got a non-registered stock portfolio, and that's going to be kind of everything that's in your account. You could go to someone like yourself and be able to give us a report, and it's going to say, okay, well, the cost base of that, let's say it's $300,000, and currently it's trading on the date of your passing at $500,000, so now you have a $200,000 capital gain there. You've got, of course, what we work with all the time is your company shares. Either you're in the middle of operating a company, or maybe now it's a holding company. Maybe you've sold it and now you're kind of in the later parts and you're just enjoying kind of your retirement. But generally what we see with the private companies is that they started their business from scratch. So then when they incorporated for a very nominal, $1. They subscribed for some shares, and over years they've kind of built it up. And let's say now it's worth $1 million as well. So now you've got another capital gain there of $1 million. So now you've got kind of your situation here, and you're going, okay, well, how do we tax each one of these items on my final tax return, which is in addition to your regular income that you earned while you were alive? So I'm going to assume you're in the highest tax bracket just to make life really easy. In BC, there are combined federal and provincial marginal rates. The highest rate over $220,000 is going to be 53.5% tax. So right away, we're going to look at your house. Normally, we might be able to say this is your principal residence. And if it is, as long as it qualifies, it still gets reported on your tax return, but there's not going to be any taxes on it. Your RRSP, like we mentioned, is going to come all into your income, and it's going to be taxed at the highest rate, 53.5%. So we're really talking, I'm going to make math really easy for myself, but you've got $500,000 of tax that's going to go right off to CRA on that one. Your stock portfolio, right now what we've got is a capital gain here of $200,000. Current legislation, current says that only 50% of that capital gain is taxable at your highest rate of 53%. So again, make that easy. 200,000, that means 100,000 is taxable, 53%. So we're going to go with $50,000 of tax owing on that. I don't want to get too much into your CCPC shares, your private corporation shares. This is an area that does have a lot of post-mortem planning. But basically the issue is that you do have a capital gain on these shares too. Now, if it's operating, you may actually be able to claim a capital gains exemption on qualifying shares. If it's a holding company, just kind of full of real estate, that may not be available to you. So it'd be a standard capital gain. I'm going to ignore the exemption for this part because it does get a little bit complicated. So again, we'll keep my math really easy. $1 million, half of it's taxable, $500,000 at 50%. So you got a $250,000 tax bill. So these are the numbers that basically we kind of look at and we go, all right, your estate, your final return is going to have a tax bill of $800,000. How are you planning on paying for that? How's your executor going to get the money together to pay? In this scenario, we're probably in pretty good shape. Your RSP is going to be, stocks. You can probably liquidate that relatively quickly. But that's the key, is that CRA doesn't wait for you to liquidate your assets. Your taxes are due. If you die between January 1st to October 31, your final return will be due April 30th, like it always is. If you pass away on November 1st to December 31st, somewhere in there, you get 6 months from the date of passing. So that is the good thing about CRA, as much as they're going to be on you to pay your taxes, they are pretty reasonable with how they deal with their administration. And they go, obviously you need about 6 months to kind of get a lot of this information together. Usually, getting the cost base for your RSP, your stock portfolio, those could be pretty easy, but getting your cost basis for your house or the cottage, we didn't even mention the cottage, but those kinds of things, that's kind of what takes a lot of time. We even come across people who don't actually have their shares. They've owned them for many years. They're not actually in a brokerage account. They're actually the physical share. They're the piece of paper. And I have to admit, that's also, I've had clients who say, Jeff, getting my computer share certificate into a broker account just so I can sell it, I'll just walk away. I don't want to deal with it.
We've had to do that for some clients, and it takes 4 to 8 months typically to get a paper share into a brokerage, set up, structured, everything.
And that's kind of some of the frustration as the executor. So there is quite a burden being put on an executor. And so as my estate, what I want to do for my executor is I want to make it as easy as possible. If I'm, lucky enough to live a long life and I'm kind of getting to the end of I know that, eventually this is I'm gonna die. I can do things to start simplifying. Maybe I am starting to sell things. So I get people who maybe they don't have that $1 million RSP. They're very heavy on real estate, and then they have a significant gains and they don't have liquid cash. So that's where things go, well, how are you going to pay it? And life insurance can come into play, and those kind of tools can kind of help them go, well, if I had all property and I'd have this tax bill, CRA is not going to wait for me to sell when the market is right, or maybe it's a complicated property to try and sell. How am I going to deal with that tax bill?
Fire sale,
yes.
Which you don't want to do as an executive.
You don't really want to do, right? At one point, you're dead, so what does it matter? But on the other side, you're going, well, I do want to leave as much as I can to my loved ones. So that's kind of what this looks like. So again, you'd be putting that on your final return. Now, you're done your final return, and this is all happening, 1 second before you've passed away. Presumably, your executor is grieving. It takes them a while. They haven't actually liquidated any of your stock portfolio. Your RSP was worth $1 million on the day of passing, but now it's maybe worth more. I mean, the stock market's or less. The stock portfolio is seems to be very liquid out there.
Yeah.
And so then you have to flip into an estate return. So an estate return then starts the day after you passed away. And this basically collects all of the income that the estate is now earning while the executor is trying to liquidate and kind of convert things into cash. Now, not everything goes into cash. Sometimes assets will just transfer straight out to the beneficiaries. But, if you think about it that way, they now have to actually go and sell the portfolio. They need to transfer the RSPs. They need to do those things. And they basically need to actually now crystallize those gains, which would be the different value from what was reported on your final return.
And this is the problem. I've run into this with a few clients where they say, look, Adam, I have a stock portfolio worth $1 million and I have a cottage of $1 million. And one kid's getting the cottage and one kid's getting the stock account. But the problem is that it doesn't just pass out that way. Like the cottage could go to the one kid, but there's a tax bill due on the cottage, which is in the estate. And the investments, by the time they pay out, there's tax withheld and there's a lot less. So you have to be aware of how these assets pass at death too. It's not as simple as possible. You need to have an estate plan around these assets.
Exactly. I generally say it's easiest for those reasons to push it into cash and then just distribute cash after tax. But you're right. The cottage has that sentimental value. You want to kind of pass it down. Maybe one of the beneficiaries really wants it, but then there's usually equalization payments that need to be calculated. So that's something common that we kind of help people with. So that's kind of what that looks like for your final return. And then your estate return, it rolls in. The good news about estate return is you do get your marginal graduated rates like an individual, just as if you were alive. Which
an estate is like another person almost.
Exactly. Yeah. It's not lost on the CRA that it might be someone's strategy to say, well, wait a minute, if the estate gets another graduated, rates, from zero all the way up, gee, I'm already in the highest tax bracket. I know what I'll do. It's all my money anyway. I'll just let this estate, last forever. Government says, yeah, we know about that. You get 3 years of that graduated rates, and then eventually it's just going to move back into the highest rate. So
at the end of the day, Jeff, what are the tips that people could use or a strategy someone could use to keep the whole encompassing process of the estate when they die a lot easier for everyone around them?
Well, one of my clients, I love it. What he called it was his doomsday book. And I actually recommend it to people. So I go, it really was either a file or in his case, a binder where you put all this important information in. It's an important book. You want to be careful with it. But it had a copy of the will. It had a listing of all of his bank accounts, his investment portfolio. It had my business card in it. He had a cottage. It had kind of the original purchase papers in it.
Oh, wow.
And so it kind of went through, basically what we did here is all of the assets that he had kind of listed out the cost basis of it and then who to contact to find out what the fair market value was. So he made it really easy that way.
His executor.
Very rare that people have that. Absolutely. The other thing that we do with our corporate clients is we'll say, why don't we actually host a meeting with your executor if you feel comfortable, maybe with your family members who are going to be the beneficiaries, and we kind of talk a lot about this.
And I've talked about this on the channel before. Like Steph and I, we sit down every quarter and I have a net worth statement and we'll link our net worth tracker below. If you're not tracking your net worth, do that because it gives you an idea of is your net worth tracking, but it's actually a great tool because it lists all your assets. So if you did pass away, at least someone has a list of those assets, which is important to have.
That, I like to think the value that I bring to the table, that Clearline brings to the table is our tax knowledge. But I think sometimes the value that I bring is the comfort that I know their situation and that if they were to pass away, that their spouse would have someone that they can go talk to.
I had a client about 10 years ago. So husband, wife, good clients of mine, long-term clients. And she passed away suddenly. And she passed away on a Wednesday. And the very first call he made, was my office. Do I like to get those calls? No, but it shows the value of if you can build a relationship with your advisor, with your accountant. They know your world, and it probably if you lose a spouse or loved one, they may be the first person you're calling, and that's a good thing because they have that financial world. I kind of walk them through it, and we restructured stuff over time and took care of them. Anyway, so hopefully this was helpful for you guys. Again, if you enjoy these videos, if you enjoy having Jeff on here, we love to do more videos. So if you have content for an accountant, so things we've been thinking about is the cottage. We get a lot of questions of, hey, we have a family cottage, we want to pass to the kids. How do we do this without paying tax? Not really possible, but there's strategies that you can look at. So we'll probably do a future video on that. If you have any other ideas for Jeff and I for a future video, post a comment below. We'll add it to the list and we'll try and launch that here in the next few months going forward. So thank you so much for joining us today. Jeff, thank you for joining us and sharing your wealth of knowledge here. And we'll see you in the next video.